again, welcome. As is our habit, we'll keep the bio or the introduction in an abbreviated format so that we will have enough time for us to spend time with Richard this morning. Richard Dresdale is Managing Director and one of Fenway's co-founders. Previously, the principal of Clayton Nuclear and Rice from 1985 to 1994, and an investment officer with Manhattan Manufacturers Hanover Venture Capital Corporation. Mr. Dresdale received a bachelor's degree from Brown University. He currently serves on the President's Leadership Council of Brown University and a member of the Board of Directors of the Brown University Sports Foundation and the Westchester Community College Foundation. He previously served as a trustee of the Bronxville School from June 2002 to 2008 and is a board member of Lawrence Hospital. Fenway Partners is a middle market private equity firm founded in 1994 and based in New York with approximately $2.1 billion in capital under management. Fenway invests in profitable businesses with significant upside potential. Fenway companies have leading franchises and operate in two core industry segments, branded consumer products and transportation and logistics. With significant knowledge and success investing in these industries, Fenway has built a strong reputation for its hands-on approach to supporting portfolio companies. It really is a pleasure to have Richard with us this morning. Richard has been a good friend of the college for over the years. I recall when I first came into the presidency many years ago as a psychologist who had never really looked at an operating budget before in my life. I had gone and found people like Richard in the community to come and help me think through. Richard, and there's several of you are here in this room, and it really has been a great help for the future of the college in this community. Richard, thank you for coming out.
Thank you, Vijay. Good morning. It's a pleasure to be here this morning. It's also a pleasure to see all of you here with me. Vijay, thank you. Thank you, Emma. Paul, thank you for inviting me to come speak this morning. I would like to comment, my good friend John Priesting and I, as you know, served on the school board here for 6 years in Bronxville. And we always used to comment how few people were in the audience at our school board meetings, although we knew that many of you were watching us on cable TV. So it's clear that we had to serve food, John. By serving breakfast or lunch or dinner, we would have had a lot bigger turnout because we always used to look in the audience and hope to see a lot of our friends and neighbors. And now we can see how it happened. As you probably know from looking at the topic of my slides here, I did shift this discussion over to talk about private equity to try to stimulate some thinking. But embedded in my discussion today will be what is happening in the credit markets. And I guess I'll just step back for a second and just say that the interest to all of you as to why this topic is of interest beyond why you decided to come out this morning is that the kind of companies that we invest in and the kind of businesses that John Hill's firm invests in employ lots of people, spend lots of dollars in the economy. And when our companies succeed and do well, that helps all of us. And the issue today that's facing us, and I'll talk in some detail about it, is the kind of headwinds that we're facing and the kind of issues that we have. Now, Vijay has given me an opportunity to do a little of a, I'm sorry, here. Emma, maybe give a little help just to get started. I don't want to. Vijay did a nice job on my presentation, a little advertisement for Fenway. I'll just do a quick Fenway advertisement. I'll speed through that, and I'll get into my slide tab. Okay, so Fenway Partners, basically my perspective, it's important for you to know my perspective. When I left college, I came to New York, worked for Manufacturers Hanover as a middle market credit lending officer, and I've always been involved in working with mid-sized companies. Our firm, which we started in 1995, focuses on mid-sized companies, and that would be businesses with $100 million to $500 million in revenue. We do have a focus in two different verticals, and that's based upon the historical experience of our partners, consumer products companies and transportation, logistics, and specialty distribution businesses. So we delve deeply in those businesses. We work closely with the management teams. We are control investors, so we're very close to the assets that we own. We don't run them day to day, but we do spend a lot of time at our businesses and working with the management teams. Based upon the kind of investing we do in a traditional private equity approach, my partners and I have a lot of experience in the space. There's 6 partners in our firm. The age ranges from 38 to 58, and the experience is in excess of 20 years on average. And these are all people who haven't just been involved in the financial community, but have spent time working inside operating businesses. And as we'll talk about, one of the issues today in investing and investing in private equity is the ability to work closely with your companies because they're all facing different kinds of challenges. So it's not just a financial exercise. And as you can see here, we've performed pretty well since 2000, which is one of the reasons we still have capital to manage, which is one of the reasons I can be here with you this morning so that I can go back to my job when I'm done. To give you a sense of some of the brands that we own, you'll recognize some of these companies, others you won't. 1-800-CONTACTS is one of our more recent investments. American Achievement, you'll recognize the brand name Balfour Rings. So you probably have seen the Balfour Ring brand name. Also Taylor Publishing. We have a sporting goods business, which is almost $1 billion in revenue, which is Riddell, football helmets and equipment, Bell, Giro, and Easton. And some of the businesses at the bottom half of this chart are companies in the transportation space, which you probably would not know. But these companies move products from shipments off the ports to warehouses to manufacturing facilities. We do a lot in that area, and that's actually an early indicator and a very interesting barometer for our economy. So I'll talk a little bit about that and what we've seen. And what I would say just in a short form is that starting in 2006, we started to see some of the issues in our economy. Our company, Panther Logistics, you'll see the Panther in the middle, is a just-in-time logistics business. That company will pick up, if you have a manufacturing facility in Cleveland and you need to get a part within 700 miles, and it's got to be there in 90 minutes, this company will have a van, a truck, it can be a semi-truck loaded, will move that product from the facility to the customer within 90 minutes. And that business obviously is an early indicator for what's happening in the economy. When we invested in the company in 2005, it did a lot in the auto industry. It's based in Ohio, as I mentioned. We've moved that company more to the pharmaceutical space, to the government space. They will move munitions and materials that have to be moved in just in time. But that company was an early sign that the economy was weakening. We saw that early in 2006. So private equity, to answer the question that John asked me a few minutes ago, private equity will survive, but it's certainly a very difficult time, and there are a lot of challenges we're facing. This cartoon kind of says the beginning of my career was in 1980, and at that point in time, people didn't want to hear from the federal government. And then we moved to 2008, and all of a sudden, people who never were thinking they'd have to talk to the federal government are saying, "Can't help me out." And obviously, I'm talking about the large financial institutions. Private equity firms are not getting government bailouts, but obviously, what's happened across our landscape with the large financial institution has been overwhelming. I never thought I would see it in my career, and obviously, we've seen some amazing things happen, but it's a different time. This slide just gives you a sense of what private equity means today. There are over 2,000 firms that exist. When John started his firm, we started Fenway when I was a Clayton Dublier in the mid-'80s. Obviously, there were a handful of firms in this industry. If you look at the UK, which is really suffering even more than the United States now due to the financial crisis, 1 in 5 companies is owned by a private equity-owned company. $1 trillion globally under management, and obviously that's how it affects us all. Either if you're a pensioner of the state of New York, if you're in the fund of funds, all the different ways you participate in private equity and have money in private equity, many of you probably do in different aspects. And I guess one of the things I'd point out, the things that happened in the last 4 years, the slide or the comment on the bottom right, 40% of all the buyouts that took place in the last 30 years took place in the last 4 years. And why did that happen? And we'll talk about that. Well, there was an excess amount of credit available in the marketplace, which really ended up being unhealthy. And I think probably as we talked about in our firm, and we spent a lot of time talking about what was going on in the marketplace, it didn't make sense to us, the amount of liquidity which was available. We had lenders coming to us, offering us to borrow 6 times and 7 times cash flow to buy businesses that we thought were worth 6 and 7 times cash flow. Now, I'm happy to say we didn't buy many of those companies, but lots of people did, and that's one of the issues that you face today in the marketplace. People took on inordinate amounts of debt that was available from lending sources and bought businesses which inherently weren't worth that value. You just think about what that means, and we'll look at some slides on that. Now, the way it was, and you can see people looking and finding the fountain of funding, and that's exactly what existed. Lots of people were out there and found access to capital they didn't think could exist. This slide also points out, just look at the chart on the right-hand side, you'll see the dramatic growth that took place in private equity financing. All the transactions you read about in the Wall Street Journal and New York Times, you saw those transactions take place at a great level of activity that hadn't existed before. This slide, the next slide I'm going to show, gives you some sense of when I talk about mega funds, you can define mega funds as capital under management, probably $10 billion or greater. There aren't many firms in that space. There were probably 15 firms that occupied that space. You read all the headlines about them. Let me describe what you see here on this slide, and there's one area I'll point out to you. On the left-hand side, what you see there is what equity was available, and that's $234 billion. So in the old days, before the bubble burst, you had fund capital from limited partners, institutions that give firms like ours, but in this case the mega funds, dry powder. You had those investors providing co-investment on top of it, that other little blue bar. Then you had the banks stepping in. Many banks then were told by the mega funds, we need you to provide additional equity to us to complete these very large transactions. And then you had the GP, those of us who manage the firms putting in their own capital. So roughly $200 billion of capital in place to buy businesses. Now, drop off, if you go to the next large tunnel there, the next large tube, you'll see 2, 3, 4, 7. It really should be $234 billion, not $2 trillion. So $234 billion times 4. That's an average amount of leverage which was available in the marketplace. Actually, in some cases, it was greater than 4 times leverage. So if you take the amount of equity that's there, the leverage which the banks provided, that gives you more than $1.2 trillion of buying power that was in the marketplace available to these large mega funds. Now, on the far right-hand side, and these numbers are a little bit dated, this was really from late April, if you look at the market caps of those companies, those Fortune 500 companies, you can see where they stood. So if you think about it, there existed in the marketplace before the bubble burst a large amount of equity capital which was leveraged at 4 times or greater, which provided buying power. And you probably remember reading the headlines that said, where will it end? What will be the largest leverage buyout that will take place? So there were things happening in the marketplace, transactions being discussed, businesses being bought that probably should never have been thought about being bought on a leverage basis, and we can talk about that later. So where are we today? What happened? Well, all of a sudden the banks, which had a lot of capital, didn't have the capital anymore, and obviously the banks were finding out, and I think I should say this, people were concerned, and there were many of us concerned in industry, that the leveraged loan issue would be the area of crisis that would cause the markets to tumble. As we all know, it wasn't. It was the mortgage business. No one was quite sure what was going to happen, but it really hasn't been the leveraged loan portfolio, albeit that there's some issues of risk there we'll talk about today. There was concern about the real estate mortgages, which are still a factor in the marketplace, and obviously the mortgages which individuals took. But certainly the leveraged buyout portfolios were a concern. So what's happened today and where are we now? Well, let's shrink this back down. So today, the mega funds, which are still, there's probably 10 to 15 of those firms out there today with funds in excess of $10 billion. Now the equity powder is less on the left-hand side. They can borrow maybe 1 times equity, and probably not even that. So that says today you've gone from over $1 trillion of buying power down to $200 billion. Now what does that mean? It means a couple things, and this is an area of discussion in our industry. You have large commitments by investors into very large funds which can no longer put those dollars to work. And those commitments obviously they're being paid management fees. And there's a lot of discussion now. We can get into this also. It's discussion I'm sure that, John, you talk about in your firm, where the institutional investors who invest in our fund, in other firms in private equity, are sitting with unfunded commitments into very large buyout funds that will not get spent, and they're very upset about it, because they're seeing today paying fees to managers where they're never going to see the dollars invested. And that's another issue we can talk about, that's causing the institutions, and these are the public pension funds of New York, New Jersey, Connecticut. These are the top blue chip institutional investors across the country and outside the U.S. So what's happened? Now, we know on Main Street, obviously the economy, we've headed into a very difficult time. Unemployment's at a 15-year high. We've seen a contraction in real estate prices, which has affected consumers. And where's private equity? Well, private equity, the debt bubble has burst. Earnings have dropped, which is most critical, and we'll talk about that, because even if you've taken on leverage of a reasonable amount and your earnings has fallen, all of a sudden you're much more leveraged just by the fact you've lost that earnings base. Multiples, purchase price multiples, have fallen dramatically, which means businesses which you acquired, if you bought a business in the last 12 or 24 months, that multiple of ownership value that you've paid for the business has come down. It's certainly not worth what it was before. And very importantly to us, to our investors, to all of you, directly and indirectly, the portfolio companies that exist in the marketplace today, in our case it's 10 companies we own control of, those companies are potentially at risk, either due to earnings shortfall, potentially over leverage, or whatever is happening. And what does that mean? That means that capital that's been invested in the funds, in these portfolio companies, could potentially be lost. And that goes back to institutional investors and to individuals on a broad basis around the world. And investors are scared. And this is not just individual investors. I'm talking about institutional investors. Now, what do I mean by private equity companies, portfolio companies at risk? What this says right now, if you look at it, there's a concern, and this is actually based upon a study that BCG did of 328 portfolio companies. What they're saying is that if you look at where the debt is trading of those companies, a spread greater than 1,000 basis points is indicative of a distressed company. This says that there may be as many as 60% of the portfolio companies of private equity firms are trading at distressed levels, which indicates there's problems out there. And I know we have some people in the room that are involved in distressed investing and advising, and that obviously is why the distressed investment community is seeing a lot of activity. This comment, 50% of private equity portfolio companies at risk of default. Well, let's step back and say what that means. Many of them are very good businesses. They could be very solid businesses. They may have had a loss of earnings due to the economy that we're in right now. They may have borrowed a reasonable amount of money when they were purchased, some cases not, and now they're potentially at risk of default. And if a portfolio company that we own or another private equity firm goes into default, in today's world, you're really in a very high-risk area, because even if the company, and we have certainly a lot of experience in this, a company is a solid business, a solid franchise, a good earnings base, but you end up in default with your lenders, you're in a very precarious position today. The lending community, we'll talk about this in detail, is really in a state of disarray, and there's obviously a lot of issues out there for the lenders. And quite frankly, the people who lend money to mid-sized companies, whether they're owned by private equity firms or not today, is a very different universe than when I first started in the world of finance. I'm not an economist. I did pull some information from Goldman Sachs, which is just a firm that we happen to do a fair amount of business with, and they were helpful. And I got some information here, which is information accessible to all of you. And this just says, this is one point of view, and you all can, we can talk about what we think. This says the economy will stabilize mid to late 2009. Clearly, there's been a great amount of intervention by the federal government, which is, at this point, it feels a little bit better today. Today's news, the news of the last couple of weeks, looks a little bit better. Unemployment hopefully will peak at the end of 2009. There is a risk of inflation, but I think that there's a view out there, at least from this point of view of Goldman Sachs, and this is one group that advises firms like ours that sees an uptick in the economy, or at least a stabilization in the economy, which will be helpful to all of us. Well, here's another point of view, and I'm not going to take a market view. I'm just going to lay out the 2 points here. Is this a bear market rally or a bear market bottom? I guess you could say right now on the bull case that we've seen some things that indicate that there is an uptick in the economy. Industrial production is stabilizing. The thing that's most concerning to me, and we see it in our portfolio companies, obviously, is unemployment. Jobs are continuing to be reduced, and we all can feel that. We feel it here in our community, clearly. And I think the issue is, and I'll talk about our perspective, you're seeing job reduction still take place. Managers, even of very solid businesses, not comfortable yet they can invest in new jobs. Now, certainly we are still investing behind product and product development, maintenance of our businesses, but the issue is, can you really plan for job growth yet? It hasn't happened. And obviously on the right-hand side, you have the bear case, which says that it'll take a lot longer for the recovery. I'm asked pretty frequently what we believe. We certainly are continuing to plan to be very conservative. We're hoping to see an uptick in the economy in 2010, but we're managing our portfolio of companies in a very conservative way right now, not anticipating we'll see an uptick in the economy, and I'll share some insight from a meeting we had in our office yesterday. Now, this is really one of the key, the next 2 slides are really kind of a key perspective, I think, to talk about what's really going out there, what a significant risk is for us and indirectly for all of you as you look at these companies. If you think about what's happened, if you go back to my earlier slides and what happened in 2006 and 2007, all the transactions that took place in the LBO world and a huge amount of debt that was incurred. Well, the term of that debt is typically 6 or 7 years, depending upon the credit. Well, those transactions, those balance sheets have to be refinanced. And if you look at these numbers, one of the things that's hanging out there as a huge overhang in the marketplace that's a topic of a lot of discussion among myself and our peer group is that there needs to be a refinancing that takes place peaking in 2014. Now, if you take a look at those 2 lines, the dark blue line are leveraged loans. Those are loans held by banks, financial institutions. And then you've got the high-yield bonds, which are the blue line. So what this points to is that as we approach the next 3 years, 3 to 4 years, you're going to see the need for companies, the mid-sized portfolio companies, large portfolio companies, the many, many companies held in private equity portfolios. Those companies, many of those companies need to be refinanced. Now, if you have a very solid business that's performing at plan levels or certainly at a level that's certainly adequate, but your debt is coming to term, end of term, you have to find alternative financing. And one of the issues today is clearly the inability to access financing at reasonable levels of cost and reasonable levels of term. Now, this is another point which I think you probably have seen in other ways, but the cost of bank debt, and this has been a big issue, access to capital and the cost of capital has risen dramatically. If you look at the left-hand side of the slide, you'll see, take a look at 06, you can see all the way through into early 07, you start to see a spike in the cost of debt for double B and single B credits. And then asset-based loans is the red line, the line at the bottom. And asset-based loans are typically loans for companies that have the weakest credit quality. So all of a sudden you start to see the spike which is taking place, which means that not only has access to capital been difficult, but the cost of accessing capital and the amount that is paid by companies has gone up. And the issue there is, even if you have a solid business that's had a historically solid relationship with its lenders, the cost of capital is going up, which you can translate back to the company's profitability and ability to take that cash that's spending with its lenders and invest back in its business. On the right-hand side, the other issue is that lenders in today's marketplace, people who still are committing capital, and there aren't many institutions that are, but the people that are doing it on a very short basis. The tenor has decreased. So you can imagine you're trying to run an operating business, deal with customers, deal with employees, deal with the challenges out there, but you know that the length of tenor of your debt has been decreased. So you can see from the slide, the tenor has moved down from 6 years to 5 years to 2 years, so that means that you're facing a refinancing risk. Now, just imagine running your household in this way, just when people talk about managing your credit cards. If you're running a business, a mid-sized company or a larger company, and you're facing the fact that your tenor has been decreased and you're going to have to refinance your business, you're not sure where the capital is going to come from, and it's coming up in a very quick period of time, it's a very scary world. And this is really affecting businesses across the board, and if you just look at the private equity world, there are a lot of businesses inside portfolios of firms like ours that are facing these kind of issues. And so we spend time at our firm not only focused on what's happening in our portfolio companies, but thinking about what we're going to do about accessing capital when the businesses go forward. Now, the good news about private equity is our capital is committed to us by institutional investors. It's a 10-year partnership typically with a 2-year extension. So it's long-dated money. It's private capital, and the access to the capital is such that we can draw down the capital for our investors typically over a 5 or 6 year period. In our case, it's 6 years. And then we can hold the investments for up to 12 years and actually extend it beyond that. So the good news about that is we're not under the pressure as a hedge fund maybe or a public equity manager to generate returns over a 6, 12, or 24-month period. Our capital is being managed over a long period of time. So one of the issues that we're focused on, depending upon our portfolio company, we have some very good businesses, have faced some headwinds. We're starting to see them come out of it or hopefully coming out of it, is that we're expecting and telling our investors that we're going to end up holding the business for a longer period of time before we're going to exit that investment and send capital back to our investors. Now, that's the benefit of private equity. It means you have to keep cool. You got to, certainly drink decaf coffee. You need the perspective with your investors, and that's one of the issues of experience. People talk what experience means. In our case, certainly I know in John's case, the partners of the firm have been through multiple cycles. In our firm, we've been through cycles starting in the early 80s, the 87, the 90 period. So we have been through various cycles before. This isn't our first time. I would say that if you run into a 35-year-old private equity professional, he or she may look very scared and harried because they've never seen a market like this before. And it does make a difference. Experience, although I'm certainly speaking from a perspective where I'm going to pat people on the back with experience, it makes a big difference because when you're going through difficult times in your portfolio companies, advising managers how to work through their issues, trying to do with lenders, having been through this experience before does help. It doesn't mean you're going to solve the problems any more easily, but it gives you the confidence to work through these issues. And most importantly, maintain confidence not only with your portfolio companies and the management and employees, but your investors. Because investors we talk to, which as I mentioned are public pension funds, private pension funds, endowments, they're going through a very difficult time. They're scared. They've seen loss of value in their portfolios, and they're trying to determine whether managers like us will deliver value to them over a long period of time. Sure.
Why is your asset-based lending value at a higher spread compared to the
You know what? Let me just finish. I'll get through the slides. I'll come back and I'll open up for questions quite a bit. The other point I make here on the high yield market, and this is also a positive sign right now, there has been, if you take a look here, you can see that after a period of time when people were taking their money, this is the money outflow, people taking money out of their high-yield mutual funds, you've seen in recent months people putting money back in the high-yield market. And you've seen today, in fact, the news today about some debt issuance. The high-yield market has come back to some degree, which is a good sign, a positive sign. That may be for new transactions, which are few and far between, but also for companies trying to get refinancing. This also shows here, this is a busy chart, this is the high yield market and shows issuance, and this is 07, 08, you can see late 08, nothing happening, and you see some uptick here in 09. So what this says is that there is a sign of some activity taking place in the high yield market. It's some positive signs, you've been reading about this. Here there was nothing taking place, no new capital being issued, and obviously over here you can see during the peak of the market, obviously a huge amount of capital is being raised. Now, let me go back to private equity perspective. I touched on this a little bit. This is from a study that was done by a firm called Probitas. Probitas is an advisor to institutional investors and to general partners. And they did a study about midway through, I guess probably sometime in March, that talked about how investors in private equity are feeling. Well, on the left-hand side, you can see that their expectations for committing new capital to private equity funds was they were going to pull way back on the larger funds. They're going to commit some dollars in 2009, being the darker chart, to smaller funds. Now, on the right-hand side, what's the fear about private equity? Let's kind of go through each one. And this is from investors in private equity funds. First thing is that the high purchase price multiples that they saw companies being bought in 2005 and 2007 will hurt the returns. If you pay too much for a business, your ability to get back an adequate return for the investors won't be there. Number two, what we've been talking about today, the broad impact of economic difficulties on the returns, meaning that the economic environment we're in 2008, 2009 is so challenging that many portfolio companies may go into bankruptcy, but the investors may not see any return on their capital or minimal returns. The third point, which was obviously said by almost, I guess, 40% of the people who responded to this poll, that the unavailability of leverage, the inability to access debt, will hurt companies not in acquiring new businesses, but in their inability to finance themselves going forward. And then the last part is that the increasing number of defaults will impair buyout returns. And that obviously also means there's lots of activity taking place in the distressed marketplace. So institutional investors are scared and concerned. They continue to be so. So on the left-hand side here, where are we at this point in time? Is a paradigm shift taking place? And I'll take the one point of view, a little more negative point of view. The collapse of the credit markets has reduced the buying power of private equity firms. If you have capital sitting in your fund, you're not going to be able to spend it or invest it. Cost of capital is at a cyclical high. LPs are not investing in funds today and not putting new capital to work. The vintage years of 2000, 2006, and 2007, if you invested your funds in that period of time, will have very poor performance. Earnings are being disappointment in the earnings of the private equity portfolio companies. And private equity managers, like us, will spend so much time on their portfolio companies that they won't be able to put new money to work. So it's not a good time to be in private equity. Well, on the right-hand side, let's take another point of view. When it feels bad, it's good. So in the past, people know that in very difficult economic times have been the best returns in private equity. And obviously, we can't time the market, but that's been there. There is a huge buying opportunity, probably more in distressed debt. We can talk about that. There's obviously a lot of focus. As I've said before, private equity is long-dated capital. It's the kind of capital you want to have out there because we can invest over a long period of time. And quite frankly, the last bullet point, which certainly we thought about and we spoke about, which is when the financing markets were open and there was all this ridiculous amount of leverage, that was really not a normalized market. That was an unusual marketplace. So is the glass half full or half empty? It is a difficult economic environment. I would say this, that talented private equity managers have to have operating ability in their firms, have to have knowledge of the space they invest in, and we're all going to be focusing on how we can improve our businesses in this time, and the decisions that are being made are very difficult ones right now. There isn't a lot of new transaction opportunities for private equity managers, but I'd say that people who are in this space, been there for a long time, have to use their relationships and focus and be very careful, but there is opportunities to invest. We've talked a lot about today, it is a very difficult financing environment. Relationships are more important than ever. Your relationships with your investors are more important, your relationship with your lenders. We're dealing with some people, and unfortunately there's been a lot of turnover in the institutions we do business with, but we're working with people that we've worked with for many years and trying to maintain the relationships with long-term people that we've had success with. Private equity firms are stressed. I'm not feeling too stressed this morning. It's fun to be here with you. But I would say if you look inside the partnerships of private equity firms, depending upon how those portfolios are doing, the managers are feeling a great deal of pressure. If you can imagine a situation where you've invested capital over the last 36 months, you're concerned that a good portion of that capital may never be returned. And remember, the incentives for managers is not to be paid a salary or bonus, but to get a share of the profits. So if you believe that the capital you invested will never be returned to the investors, and therefore you are never going to receive a share of the profits, that may lead to demotivation, which is a topic of discussion that takes place in firms. And people are very much spending time in their portfolio companies, and some firms are not really set up to do that. And the last part is, how do you exit your investments? If you have we have some very good portfolio companies. If you are looking today and you want to exit a company and sell it either through an IPO to the public or you want to sell it to a third party, it's pretty difficult to do that, and that's going to be a challenge. I guess the quote at the bottom I pulled out, the test of first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. We're doing a lot of that right now, and sometimes more successfully than other times. Why do people invest in private equity? Why is there still a desire by institutional managers to allocate to private equity? Clearly, look at the right-hand side of this chart. Over a 10-year period and a 20-year period, private equity managers, certainly the top quartile managers, have outperformed the other asset classes. And this is ultimately why when you talk to a manager of an endowment, when you talk to a public pension fund manager or a gatekeeper, they're going to continue to want to allocate to private equity, albeit it's challenging for them. And they're very concerned right now because they're looking at their portfolios and seeing some real concerns about ultimate performance in the last few years. A couple of points I want to make, because these questions get asked quite a bit, and sometimes in the press, and certainly the press has been focused on it. There's a lot of discussion that private equity firms are more aggressive in reducing jobs than other firms. And I guess what I would say is I don't think that's necessarily true, and I think that one of the issues that we're tasked with as control investors is to drive productivity. We're as sensitive to other control managers as to how we invest in our businesses and where we put our dollars. But I don't think you're going to see private equity managers having been the most aggressive in cutting losses. I think any manager, whether it's a CEO of a public company or a private equity manager, is very focused today on managing the businesses for ultimate success. So I don't think it's quite fair to say private equity managers are more aggressive in reducing headcount. I'd also say that private equity firms, certainly ours and many others, really try to invest behind products and managers. We do a lot of that, so that hopefully that capital will be used wisely, not to pay interest expense or pay off debt, but to invest behind products and people. The other fact I think that's interesting is, people talked in the past, and it's in the press, that private equity firms have been involved with stripping assets and flipping businesses. Well, we went through a period of time, if you look at the last 36 months, where you saw very large transactions take place. Then you saw something called recapitalizations take place, which were the ability to access the capital markets, to re-lever the companies up, pay dividends out to shareholders, and continue on. And many of those companies were successful in returning capital back to their investors, but at the same time they put more debt on those businesses. And that's been an area of a lot of controversy, and it's getting some discussion right now. I would say that as far as the whole period of private equity firms and private equity portfolio companies, if you look at that chart, very few companies have, in the last 25 years, where have you seen private equity firms buy businesses and sell them in 24 months. There have been some very visible successes, but in most cases, people hold the assets for a longer period of time. And as I said, it's one of the assets or attractiveness of private equity. Now, I guess I would also comment, there's been a lot of press, a lot of negative press that's taken place recently. The failure of Lehman Brothers, the failure of Bear Stearns, the issues of potential regulation of private equity managers, hedge fund managers. But I would point to you, if you take a look at these headlines and look at the publications and look at the dates, just going back in recent history, you all were probably reading the paper carefully at the time. There has been, in a recent period of time, and I can remember when I was at Clayton Dubilier in 1986, I had to prepare, as a young associate, I had to prepare a whole bunch of documentation to go down to Washington, D.C. with my senior partners, because the partners were asked to present to Congress on why LBOs were bad for America. You may remember that. So I guess I'd point out that we're in a period of time when there's been a lot of concern not about just about Wall Street, but about what private equity is or not doing to the economy, and I think we've seen this in the past, and hopefully we'll be able to continue there and to make some positive gains. I guess I'd say that private equity, even in these challenging marketplaces, I think does have competitive advantages. The most important aspect about private equity, and hopefully you get some sense of my comments, as a control investor in a business, there is a better governance model than exists in a public company. We exert a positive view of our companies. The model that we have, and I think that most successful firms have, is not one of passive ownership and minority stakes. It's an active ownership model. It's aggressive governance. We spending time, the managers spending time with our managers running the companies, not running them day to day, but bringing value add to these managers in a variety of ways, and being stable shareholders. As you know, it's very difficult to be a public shareholder today. It's very difficult to be a manager of a public company today. And I think the opportunity exists and continues to exist in private equity, albeit with challenges, to perform very well in this marketplace. But it's not easy. One of the most important things that we do in private equity is to assess the managers running our businesses and, if necessary, to change the managers. And that's certainly something that we spend a fair amount of time on. The other thing that's taking place now is there's an ability to reset expectations, which is happening as we sit today. And the other thing is a sense of urgency. So hopefully with this model in private equity, even with the very difficult challenges we face, we'll continue to be able to perform at a way that attracts additional capital, new capital. But as I've said, it's not easy, and hopefully we'll continue to succeed. So with that, thank you very much. I'm happy to answer any questions and open up the floor for conversation. Yes.
Rail car activity in the first couple of months has been even. And recently we looked at the activity for March and as an owner of a logistics company, I'd love to know what your input is. I think it's a great view on where we're going. And then we also know you. I have two boys that are catchers, and I had to go out and buy them catchers equipment from Easton, and
Good.
we continue to support your company.
Well, I'm glad you have two. I'm glad you have two catchers.
One's a lefty.
Okay, good. Well, the good news is you have two catchers in the family, so you have about two sets of equipment. I didn't talk about our portfolio. Let me tell you what we've seen in our portfolio. Interestingly enough, our consumer companies have performed better than you'd expect in this environment. Our company that's performing the best right now is 1-800-CONTACTS. For those of you who wear contact lenses, this is a business that used to be, under federal law, that you could only get contact lenses directly from your ophthalmologist or optometrist. The company that we invest in and own, the manager who started the business as a student at Brigham Young University, went and got federal law passed, which mandated that the manufacturers sell the contact lenses directly to the consumer, which is interesting. It didn't exist. So now if you go on our website and look at 1-800-CONTACTS, you can get your contact lenses directly as opposed to buying it from the ophthalmologist. What does that mean? It's a replenishment model. We have a joint venture with Walmart, and in this tough economy, people are spending less but continue to buy contact lenses, and that business is doing very well. Easton has actually held up quite well. Now, Easton exists. It's Easton baseball and hockey equipment. It's Bell helmets and Giro helmets for biking and for snow sports, and then Riddell football equipment. Now, I can say this, Riddell's an interesting business because you might imagine, and Bronxville will be no different, the school budgets, which pay for school equipment in case of football, which is the largest participant sport in most school districts across the country. You can imagine as school budgets continue to face economic squeeze, that the purchase of equipment will be reduced. So Riddell will probably face some difficult times or more difficult times going forward. Our transportation logistics companies have been facing headwinds for a while. I mentioned Panther Logistics was one of the earliest companies. We have a company, if you go back to that slide here, I won't put it back up. But we have a company called Roadlink. And Roadlink is a logistics business which, if you go to a port and look at the containers which come off ships, Roadlink takes the containers off the ships and puts them on trucks or rail and moves them out to various facilities. That company has been facing a very, very difficult time because the level of shipments in the United States is way off. So I got to tell you, in our transportation logistics portfolio right now, we're really having a tough time as to going through a discussion, which is, this is kind of discussions taking place throughout our portfolio. How far do you cut headcount? We had a meeting yesterday. What do you do about headcount? What's your expectation as to the uptick in the business? Where do you invest dollars behind product development? And it's a very difficult situation. I think our portfolio is just a small microcosm in that you certainly would like to see a better sense of revenue and some revenue uptick, or a hope that revenue will stabilize so we can continue to maintain our level of investment. We're having to invest behind products and behind our R&D, but our transportation portfolio across the board has been soft. We're hoping to see an uptick soon. There's been some signs that it's stabilizing. There's some floor, but overall, our experience is the same as yours. Yes?
That chart where you were showing the spreads.
Right.
I was surprised at how much lower your spreads were. You're still under 500 basis points.
That was for the asset-based loan?
Yeah.
Yeah, that was actually a slide that one of my colleagues put together from data they gathered from a bunch of sources. So, we don't have many portfolio companies with asset-based loans, but it's still a lower spread than the traditional financing model. So
That wasn't representative of private equity funding rates?
no, that was just asset. No. I think the real issue is, and I think the real problem is, where do you access credit today? I mean, if you think about it, just kind of go across the landscape, think about the financial institutions that existed 2 years ago that don't exist any further. So, I mean, it's really kind of scary. And so you're trying to find which institutions are still in business, which institutions are still lending money. We've done business. GMAC is an investor with us. GMAC is a lender to our portfolio companies. You can imagine what's going on with them. We do a lot of business with GE, through GE Capital, and actually also through Antares, which is a business that GE bought. And they've been pretty good. But I will tell you that even those guys, you remember GE had issues on their funding, they pulled back their capital base. And we were doing a small add-on acquisition for one of these portfolio companies. And literally, the guy who runs the whole GE fixed asset portfolio called us and said it was a $10 million commitment. This was about 3 months ago. Listen, if you guys want to complete that acquisition, get it done in the next 5 days. If not, we're not going to be making our funding commitments. That's GE. So
there was an article, I don't mind asking a second question,
Sure.
A cover story in Business Week talking about private equity firms. sitting on $1 trillion worth of potential buying power. That seems not to jive with some of the data that you were showing up there, and then
Well,
there was a slight disconnect.
I think private equity firms are seeing a lot of capital. One of the issues I touched on before, which is an interesting issue, which is this. There is committed capital in which LPs have committed capital to private equity funds, which hasn't been drawn. And in certain cases, there's concern by both the general partners and the LPs are saying it, the LPs do not want to have to fund that capital. And at the end of 2008, early 2009, there was a lot of discussion where certain LPs, major LPs, were calling general partners and saying, listen, we have a legal obligation to fund your investment if you call the capital. That's the way the process works. But we really don't want to fund that. So we're not going to tell you we won't fund it, but please don't call for capital. Now, I mean, that's reality. So now, it didn't happen to us. I think being a mid-market firm with just under $1 billion of capital being managed didn't happen, but there's certain general partners, and it's a lot about the relationship with the general partner and the limited partner, where they're saying, we have some problems here, we're an investor, we really don't want to see capital being invested, we're paying you a management fee. So one of the issues that you've seen out there in the press is, will LPs default on their commitments, which is an unheard of issue, and I think most cases not, but it's certainly a question. Yes?
Richard, thanks for an excellent presentation. In the Greenspan era of free money, everybody looked like geniuses. And the high leverage that took place is going to take many years to correct. So with industry now being such a small part of the US economy and services and consumer being such a big part, and they're now in a downturn, how do you think the business schools are going to change their curriculum to teach the next army of MBAs to be effective?
First of all, full disclosure, I think VG did my resume. I never went to business school, so I may be better for it, or I may be more dangerous. I don't know. I actually, when I was working at Manufacturers Hanover, I was offered the opportunity to go to business school on a 15-month program, but I was enjoying what I was doing so much, I never left. So I got a business school so to speak at night. I would say that the MBAs that I've met, we've hired over the last decade. I think there was an overabundance of people that were drawn to consulting and finance, and we certainly saw that, and something that we've talked about with some people in the audience. I think that what you're seeing now, I think the people that are, and I got a call last night from a young person who's getting ready to graduate from college. If you know your children and grandchildren, it's a very scary time for people coming out of college right now. It's a very difficult time for people in business school. And in talking to some of the people at the Harvard Business School that I have in the last 6 months, the opportunities for them and where they're looking has changed pretty dramatically. They're looking overseas for opportunities more. I don't think finance is necessarily getting most attractive opportunities. I certainly advise personally to people, young people, either whether they're coming out of college or in graduate school, that going to Wall Street never was, and certainly is not the panacea, and that if you can get operating experience in an operating company through a good training program, whether it's PepsiCo or Unilever or whatever, that's an excellent opportunity to do it. So I hope that continues. I think it got out of balance, and our perspective, my personal perspective, my bias, you can hear from my comments, is how you work inside an operating business and learning that skill base. I got that opportunity. I learned really by sitting side by side operating executives early in my career, so I learned it on the job, so to speak.
Thank you.
Yes?
Richard, the one sort of entity I don't think I heard you mention this morning comes up from behind
Question.
and Hart-Schaffner Marks, or whatever the combination of words were, and their employees apparently pushing leverage on, in this case, Wells Fargo, to not put them into default, which brings the issue called the new partner in town is Washington. Can you talk a little bit about sort of what that means to the future of all of this?
Well, let me take the second part. I think I had some conversations in the last 10 days with people in the restructuring business, and I know we have some people in the room who work in restructuring. I think that the issue on Chrysler and now GM, and what happened, what you have seen happen very recently, where the unions were able to achieve a significant ownership stake in the business, and secured creditors were put in a position of a weakness or lost their claims, or their claims were reduced, has created a great deal of anxiety. And for people in the world of secured debt, for people who are looking at restructurings, there's a concern out there that it's going to really change the model and the approach. I think it's a big concern. What was interesting is obviously Chrysler, the issue with Chrysler, which is much smaller and contained, took place just in advance to some very significant points taking place at GM right now. And obviously GM is right in front, but Chrysler happened first. I thought that the politicalization of the discussion took place between the White House and the Treasury and the hedge funds was unnecessary. And you've seen some hedge fund managers now write letters about it. And I'm not going to make a political comment, and I'm not going to say who I voted for, but I'm certainly support our president. I think that it is not healthy to see a process that becomes politicized, and I think you've seen recently where there is government involvement in a very extensive way. I would say this, that the approach, instead the people that have been brought to Washington, I do know some of the people who have been brought to Washington who are working in Treasury. There's a lot of discussion about Geithner and Geithner's understaffed. They've hired, in fact, they hired a colleague from my former firm to work on some of the restructuring areas. They've hired some very good people and brought them to Washington, which I think is very important. But I do think that you have now hedge fund managers and secured lenders very concerned as to what's going to happen going forward. So, as we see. The other point I'd make on your point about default, if you're a lender today, and Wells Fargo is obviously a very prominent financial institution that's in generally good shape, lenders are sitting today saying, okay, what's the status of your business? If you are in covenant default, do I really want to have you in default? If you are heading towards payment default, do I want to be responsible and take the keys and try to run this business? Do I want to put it on my list of things to do? So that it really depends on the institution, their sophistication and knowledge, whether they really believe that there's an opportunity for the company to be saved and to work through its problem, or the lender to take over. And as you can imagine right now, the distressed advisory firms, restructuring firms are just full out. And so the question is, does the lender really want to take on another problem, or do they want to let the company try to work through its problem? Yes?
Did you see interest rates increasing? There's a lot of competition for credit. It seems they're awfully low now. Do you see them increasing quite soon?
Well, it's out of my area of expertise. I certainly think that I agree with you. There's a lot of demand for capital. I think over time, I expect rates have to go up. I mean, the rate LIBOR right now is, 0.2, whatever. It's unbelievably low. So there's a great deal of liquidity been pushed in the system. I'd expect they have to go up, but I'm not really qualified to prognosticate. But I'd be concerned. So, yes.
So what happens in 12 and 13 and 14 when this huge wave of refinancing is coming? And how do you and your partner discussing how that period is going to get worked through?
Well, personally for us, I'm happy to say we don't have a lot of balloons. We have financings. We have some companies that need to be refinanced in 1 or 2 in 2011 or 12. We don't have a huge spike. But even if the company's performing pretty well and you have a refinancing, the question is who's going to fill that? Who's going to step in? Will the existing lender step up and refinance it? That's a big question. I mean, that slide really is, in my mind, a critical issue because the institutions that historically would have provided financing for these companies may or may not be in the business of committing new capital. Not getting into whether or not the TARP programs have worked, I certainly think there's a real void of capital availability, but that's going to be the challenge. So if there are mid-sized businesses that had pretty successful track records during that period of time, I think there'll be alternatives for it. I think on some of the very large buyouts that were done that are fully over-levered, if they get to that point in time, because as you know, those capital structures were done in a way where they have minimal, covenant light. You heard the term covenant light. There's no financial covenants which will trigger a default. So these companies are kind of moving along. In some cases, they're picking their interest so that the capital, the debt is increasing. How they're going to be refinanced and what's going to happen is unclear. And obviously, there's a question now whether distressed investors will come in and buy the debt. In some cases, private equity firms have done that. That's going to be one of the issues that's out there. So, don't have an answer. That is a real risk.
Rich, when's the roll-up happen with private equity firms?
I think that's a good question. I think I'm one who actually, I don't preach about it, but I do think it's going to happen. The Dennis's question is, you've got a lot of managers, private equity managers. Some perform pretty well, some haven't. There's capital under management. Will there be a consolidation that takes place? I think there'll be some of them. I do. And the question whether is will we get together with another private equity firm, mid-sized firm that has other expertise? We'll get together with a hedge fund. Now, it sounds great conceptually. The issue you always have, and I've been around this is a long time, is personal compatibility. If we're working together and the two of us want to continue to work together, but Joe over here doesn't want to work, will we be able to get Joe on board to make it happen, or does Joe leave? So the issue really becomes, can you get people to say they want to work together, and even though commercially it makes sense to put the business together, and then you convince the investors that 1 and 1 makes 3. I think there'll be a lot of discussion, Dennis. A couple have been tried and haven't come through, but I think there'll be more of it, and I think it'll be a question of what the right fits are. And will the investors support it? I think we're on time.